Hey everybody, it's me, CJ King with Murney Associates, and I hope that this video finds you and your loved ones feeling healthy and strong and weathering the storm that COVID-19 has brought into all of our worlds these days. The reason for my video today is, or I guess I should say tonight, is that I would like to be a voice of encouragement, if you will. It seems to me that the only thing more contagious than COVID-19 right now is negativity. And I would like to put a little bit of information out there that I think will hopefully encourage you with respect to your thoughts on what is happening in the housing market. I think that there's a lot of questions out there, and I know this because I have been fielding numerous calls and emails and just random conversations with people who know that I'm in the business with a great deal of interest in what is happening. Is COVID-19 affecting the housing market? How is it affecting the market, and what do we think is to come? So I'm just going to share with you my opinions based on 17 years of experience and a little bit of common sense and extrapolation that I feel relatively comfortable doing based on my interpretation of various data points that are available out there. So the first thing I would like to say is that yes, COVID-19 is having an impact on the housing market. How could it not, right? COVID-19 is affecting all of our worlds in every way, shape, and form. Those of us who have children in the Springfield public schools or the surrounding areas who just went back to school today with homeschool for the first day, we know that COVID-19 is affecting our world. And we miss you, teachers. We miss you, schools. But my point is, COVID-19 is everywhere. It's affecting everything, and that includes the housing market. We don't know yet how bad that will be, but I do want to say that I do not believe that COVID-19 is going to have the type of effects that we saw in the housing crisis of 2009. And I have more than a couple reasons for believing that. And three categories, if you will, would be just the basic market conditions, the things that we as homeowners have learned from the housing crisis of 2009. I'm calling it 2009 because that seems when it was most impactful here locally. And then what lenders have learned since that time as well. So speaking strictly about conditions, and what's different now versus what was happening then. I think the most important thing to point out first is that in 2009, the housing crisis that we experienced and the crash, if you will, that was a function of and a result of a breakdown in the actual industry and the system and everything related to housing and mortgage, and it was systemic. What we are experiencing with COVID-19 and the uncertainty that has become prevalent is an event. COVID-19 is an event, and it is an event also that is not even inherent to the housing industry. So comparing and contrasting 2009 to today, 2009, there was a systemic problem with the entire housing industry versus now we have an event that is outside the industry that is affecting the industry. And an event has a beginning and an end. Now, we don't know when COVID-19 will cease being such an impactful thing, but we do know that it will at some point cease being so impactful, assuming we flatten the curve and do social distancing and all those smart behaviors that we're being encouraged to embrace. So that's the first difference in 2009 to now. The other things related specific to just general conditions in the housing world would be that appreciation levels in properties that drove prices in 2009, in the 6 years leading up to that, we saw crazy, ridiculous amounts of appreciation driving prices way, way up. At the time, over those years, we saw appreciation rates between 6.5% and 12.5%. Now the average is about 3.5%. So we're talking about almost twice to 4 times the average in appreciation in properties in 2009. In the last 6 years leading up to now, and what we're dealing with COVID-19, we have been enjoying appreciation at a rate greater than average, greater than the 3.5%, but it's been about 4.5% to 6.5%. So above average, which is nice, but not ridiculous, crazy above average, which sort of set things up for things to not go great because the prices just got too high too quickly and were too out of hand to handle everything else that happened at the same time. So besides the system versus the event, and besides the crazy appreciation versus slightly above average appreciation, we also had a complete difference in the inventory. And this is huge. If you have been trying to buy or sell a home, you are probably an expert on this as well. Right now, inventory levels, particularly in 417 land, are crazy low. So we have very low supply and we have high demand, which means prices are going to go up. That's just a function of macroeconomics. So, as you have probably seen, you might see a house come on the market at 10 o'clock in the morning, and by noon you look and it's pending, it's gone. You missed out. And when you call the listing agent or your buyer's agent, you find out that not only is it gone in 2 hours, it was gone and there were 7 offers on the property, which you can probably safely assume that in that circumstance, the seller ended up with an offer that was at least full price, and in most cases, it was going to be higher than full price. So on the average in the States, we've got right now about a 3.5 month supply of inventory, and it takes about 6 months to sustain the real estate market. What we saw in 2009 was about an 8-month supply of inventory, which also had just had ridiculous amounts of appreciation. So we had an 8-month supply of high and probably overpriced properties on the market at that time with low demand. So bear with me, I'll tie it all together here in a little bit, but those are the basic conditions related to the market that are different in my estimation. Beyond that, as homeowners, we are today making different choices than what we made in 2009. So in 2009, what we found was home buyers were willing to borrow more money as a ratio of their debt to income. So we might see that a buyer would come and say, I'm pre-approved to spend $150,000, but I really want a $175,000 house, and they were going to try to figure out a way to make that happen. What we're seeing now is someone coming saying, I'm approved to spend $150,000 by my lender. However, I've reverse engineered the payment associated with that loan amount, and that's going to take me out of my comfort zone. So what I'd really like to do is buy a house for $125,000 or less, because I will be more comfortable with those ratios. And that is a nice evolution that has occurred in borrowers not being willing to just max out and buy beyond their means. So besides that, we also see that people's position, their equity position in their home is different now than it was in 2009. So right now, we know that slightly over a third of the homes in the United States, single-family residences, the owner-occupied properties, there are about a third that don't have a mortgage at all, which means they have 100% equity. If we add those to the other people who do have a loan, we see that over 50% of United States homeowners have an equity position of 50% or more, which is a really good place to be, because if something like COVID-19 comes in and affects consumer confidence, which maybe serves to bring prices down a little bit, if we have equity and we have to sell, it's okay that we have to sell for a little bit lower price because we have the room to do so, because we didn't borrow everything that we could max out against the home. Also, in 2009, we saw some very different homeowner behaviors. In 2009 and leading up to 2009, what we saw were a lot of homeowners who were pulling out all of their equity. So they would borrow against their home or do a home equity line of credit or do a cash out refinance. So they would take money from their appreciating asset and they would use that money for something not related to their home, like going on a trip or buying a boat or an RV, something like that. So when you think about what a home equity line of credit is meant for, it's meant so that you can improve your home. So if I borrow $50,000 against my home and I pour $50,000 into my home, then I can reasonably expect that my property value should go up. Now, it's not going to go up dollar for dollar. It doesn't work that way. Remodeling, it just never does. You're not going to get 100% return. But if you do take that money and you borrow it and you pull it out of your property and you put it back into your property, it's reasonable to expect that your home is now worth more than it was when you started. That is not what happens when you take all of your equity out of your house and go buy an RV. You've hurt yourself when you make that decision. And what we see based on the percentages that people are holding in equity, we know that consumers are not making those choices anymore, or at least not as many and not as often. So those are some really good lessons that we as borrowers have learned to do differently, which how that affects things and how that ties with the market conditions with COVID-19 specifically. If I have borrowed less money than I'm qualified to spend, so my debt to income is lower than what is acceptable, and I haven't pulled all of my equity out of my home and I'm not in a zero equity position, then if I am in a two-earner family situation and my spouse or partner loses their job or gets temporarily laid off, because we haven't maxed out every single dollar that we were able to borrow, if we have a little financial setback like that, we're probably going to be more likely to be able to weather the storm and continue to make our mortgage payments, because we weren't, trying to borrow more than we technically could afford, like we were comfortable doing back in 2009. So that's a very real change in what we're seeing now versus what we saw then. The other thing that we're seeing is that the lending or the mortgage industry has learned as well, which is great. So the first thing that's different now than we saw in 2009 is that we're not seeing lenders make these stupid ridiculous BS loans that they used to make at that time. So back then there were loans that, it's probably not the technical term, but it's the term that realtors use, and I know some lenders who have as well. We would call them a NINA loan, which was no income, no asset, or a NINJA loan, no income, no job or asset loan. It was unbelievable, the people who could obtain loans and the amount of loans. We would joke, you know, if you could fog a mirror, you could buy a house. It was that easy to qualify for a loan. So the lenders are not making those foolish choices anymore. They tightened up after the housing crisis. They tightened up the requirements to be able to qualify to buy a home. Yes, it's lightened up over the years subsequent, over the last 10 years. The restrictions and the requirements for getting a loan definitely are a lot more lax than what they were at the time. But they are, or I guess at the time following, but they are definitely a lot stricter than what they were leading up to the housing crisis. The other thing that is happening that's different now than in 2009 is that we see just recently that FHA announced that for all government-backed FHA loans, they've declared or implemented a moratorium on foreclosures and on eviction proceedings for at least 60 days. So that's very different than what happened in 2009, because the foreclosure proceedings became prevalent and pervasive in the industry. So to sort of show you the difference between what was happening then versus what's happening now with this moratorium. In the days and years leading up to 2009, you had people who were borrowing at least as much as they were able to spend. They were spending more than they probably should have spent. They were borrowing against their homes to make decisions for purchases that were outside of the home. And as what happens when the prices go up so steeply over the years, at some point the market has to correct. And what we had then was we had really high supply and we had low demand. And as a function of economics, high supply, low demand means lower prices. So as people became unable to sell their homes because they owed more on their homes than it was worth, then they started missing mortgage payments. And or maybe they had a medical crisis, or maybe they got a divorce, or some circumstance that required them to sell the home, or required them to or made it such that they couldn't continue to make their mortgage payments. So when those things happened and the banks initiated foreclosure proceedings, what then happened was we took an already oversaturated market high in supply, and then we began flooding that market with distressed properties at drastically reduced prices. So now our overabundant supply just got worse, and to make it worse, the properties that were becoming available as a result of the foreclosures were very deeply discounted. Why were they discounted? Because the banks don't want to own property. The banks want to own notes, and they want you to own the property, and they want you to pay them, but they don't want to own the property. They don't want to maintain the property. We're talking about thousands of properties that the banks held across the nation, that they weren't there to manage the properties, to pay utilities on the properties, those kinds of carrying costs. The banks just aren't meant to do that. That's not what they were for. So they were cutting prices, throwing the houses on the market, which then created additional supply at reduced prices, which then meant if I had my home where I was in a zero equity position and I was at the top of the market because the prices had gone up and I was trying to sell it at that price, and I was competing with a property across the street, same house as mine, but it was owned by the bank, but they were selling it for $30,000 less than me, an average buyer is going to choose the cheaper property. So as that happened, as supply continued to increase and as average prices came down because of foreclosures and short sales, then everybody's prices came down. And as those prices came down for traditional homeowners versus REO or bank-owned property, that's the term, distressed properties for REO, bank-owned properties, as those people then had to try to sell their home that they borrowed everything against, now they too had to sell for less than what they owed, and those people then had to do short sales, which again further exacerbated the problem because we just keep having this situation where the prices just keep dragging themselves down, 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 down. So you compare and contrast that circumstance to today, where people are sitting in a better position, how much they borrowed versus how much they earn, and they're sitting in a better position for equity, and the lenders made good loans with people who are able to qualify for those loans, and now the banks are recognizing, hey, this COVID-19 is impacting people's lives. People are getting laid off. People are getting sick. There are medical bills. There are, circumstances. We're going to just call time out, and we're not going to foreclose on those people and make this problem worse. So you can see that between the conditions being different, the homeowners being different, the lenders being different, the landscape of the conditions that we're seeing right now, today, in the face of COVID-19 versus where we were in 2009 are very, very different. And I hope that as I kind of walk through that, you're able to see those differences and understand those differences and realize that even though the market is responding to COVID-19 and there are some uncertain times ahead, there are some sellers and buyers pushing pause right now temporarily while everyone sort of wraps their brain around what's happening with COVID-19. We know that this too shall pass. And hopefully you can see that I think that in the end that we will come out of this stronger, and we will have sustained and been able to maintain things without going into a full-fledged crisis mode like we saw in 2009. So I guess I would just sort of summarize and wrap up by saying, if you have had any thoughts of buying or selling and you have questions about what is happening in the market and how it is going to impact your choices here locally in 417 Land, please reach out to either myself, or if you have a trusted realtor of your own, please do not rely on the headlines, and please don't rely on the media and the clickbait and add to the problem and make it worse, and a self-fulfilling prophecy type thing. Please rely on your local experts, whether that's myself or someone else who's been in the business 15, 17, 20 years, someone else like me who's been through the housing crisis and sharpened their skills and experience and those types of things that got us through then, that we're able to bring to the table now to help you. Please reach out to one of us. I know I speak on behalf of all great seasoned realtor veterans in saying we would love to talk to you for free, for no obligation, just a consultation to help calm everybody down, to help you feel more comfortable, to help you feel more confident, to make good decisions about what you want to do and how you want to move forward. If it's not me, there are other great agents out in the industry, and I encourage you to reach out to one of us. We also, as seasoned pros, we have developed relationships over the last 10, 15, 20 years or more with lenders who have the hearts of teachers who want to help you understand what's going on and how to make good choices financially as you move forward in your real estate goals and dreams and what you're trying to accomplish. Together, we would all love to help you gain a better understanding, maybe help you decide on what's best for you and your family in terms of timing, so that we can all sort of weather this storm together and come out on the other side better without having to go to the very worst place, because everyone is sort of maintaining a level head and has a good understanding of what's happening today and why it doesn't have to lead to the crisis that we saw in 2009. So again, my name is CJ King. I have been a realtor with Murney Associates for 17 years, and I would love to visit with you, whether that's because you comment or email me, text me, look me up online, call me. I promise if you reach out that I will get back to you, depending on how many of you actually do. I don't know how fast it will be, but I promise I will get back to you because I think one of the most important things that we as professionals can do is help maintain the calm, non-overreacting, non-over-responsive, over-dramatizing situation that sometimes happens in times like these. So thank you for watching. I hope that this was beneficial to you. And if you want to reach out, that would be really great. Otherwise, just please stay healthy, keep making those good choices, and let me know if there's anything I can do to support you. Have a great day.